Hey guys, this is Matt from Optimus Futures. I'm going to go through the second step of showing you how to use the multiple time frame indicator on the charts. So I'm going to get right into it. If I don't look at you directly, it's because I have to look at the charts, so I apologize. Okay, so yesterday we looked at the daily range. This is what we analyzed right over here. This was the first one. And again, what I explained, this is the average true range as measured in percentage when we look 5 periods back. So when we look at the daily ATR, looking at that. So whatever time frame you use over here, this stays pretty much constant, which is looking back at 5 days of the average true range, and tells you the last bar, the last daily bar, what obviously today's didn't complete yet, but anything up until 5 days, so up until this one right over here, it shows you the daily range. Now we're going to go to the second step. Okay, 1 second, I'll bring it here. Okay, this, what I'm going to talk about is the 4-hour range. Okay, and this one looks back 12 bars back on the 4-hour range, and we see the percent here is 354. So as you see, the volatility in, we're starting out with the spot FX market, which is the cash market on USD Japanese yen. You clearly see, what kind of range we had. And this is an average of 354% relative, okay, to the average true range of the last 12 periods as measured by the 4-hour range. Now, if you see over here, what you can do, let me see the time frame. This was in the 4-hour, but even if you're trading the 1 hour, okay, it would still show the same thing because it measures basically the same thing. It measures the 4-hour average true range. Again, so if you, for example, trading a 1 hour chart, you can maybe do something shorter. Let's see if we can do something shorter here. Let's say if you're trading the, let's assume you're trading 30 minutes, okay? Okay, there we go. So now we have the 30 minutes, and we're just gonna wait for this to update. Okay, as you see, the numbers have stayed the same because it doesn't matter what time frame you're looking at. The 4-hour range, looking back 12 periods, still it tells you that it's 354. What does it actually tell you when you're trading short time periods? So when you come into the market, for example, today, this is what you see, right? You see ups, downs, down, up, and you're trading. But if you actually look at the ranges here, you first look at the daily range, which is 200%, which is double than the last 5 days. You see the daily range is double. Then you look at the 4-hour range, okay, which is a time frame one below, and you still see that this is huge, 354. What does it tell you? Okay, again, in the previous video, which Jake is going to make a link to, right, Jake? All right. I discussed how you placed your stops according to the range of the markets and how you also place your targets. So this is clearly a very, very volatile period for the Japanese yen. And if you're trading short time periods, you might consider doubling or even tripling your risk and reward here looking at that. So again, constantly coming every day to the market and just trading the same way, saying I want to have 20 pips or 2 ticks or 5 ticks or 2 points in the E-mini S&P, it's not going to work. It will work if the averages here are normal. I mean, if they're rotating around the same percentage, near the 100% or slightly below. But over here, now you're seeing that your method has to be slightly adjusted. And as you see, now that we reached the next period, then you see those things change. So let me go through the markets. Let's examine them, okay? And go from there. So again, we in the first video, we did the first one, which is the daily range. Now we're going to look at the 4-hour range. And I'm going to tell you this. It is Yes, you can run those and calculate those and create all those indicators by yourself, but with this indicator, we just made it really easy for you to come in every day, look at it, and obviously decide whether you want to trade that day and whether, again, it fits your risk profile. So here's the USD Japanese yen. Let's look at the euro, okay? The euro USD, and this is very interesting. So look at the daily range here. The daily range tells you that it's at 97%. So we have basically, we're at the same average as the last 5 days. But we see that on the shorter time frame, right? On the shorter time frame, we're at nearly double. So it's 193. Let's just round it up and say it's 200, just for simplicity. Now that it's double. So again, on the shorter time frame, it's double. So it means that today's the volatility as is measured right now, okay, for the last 4-hour range is double. What does it mean? Again, you know, we have daily, which is normal, daily range that is double. At this point, you can decide based on today's volatility if you want to double your risk reward. You may not. It depends. You have to look at the bars because we have a daily range which is normal and a 4-hour range which is very volatile. So the opportunity might be very short-lived for higher risk and high reward. Let's go to the next one. That's the USD. Here, the daily range is below the average and the 4-hour range is 50% higher. Again, you know, I wish the trading was, you know, complete science, but it's not. It's an art, and a lot of the time it's a judgment call of what you want to do during the times. This would be very conflicting for me because I see, what I like to see is volatility that is down across the board in all time frames. This is what we're really looking for. We're looking for time periods that everything pretty much coinciding, right? But here we have something which is completely different. We have a daily range which is lower than the 100%, which is at 80% relatively to the other 5 days. But the 4-hour range is, but the short-term range or the 4-hour range is a little bit higher. So here we might encounter a little bit of a higher volatility. I probably would have skipped the trade because it doesn't give me clear anything. Tomorrow we'll talk about the 1-hour range here, which is, you know, 400% higher, but we'll get into that tomorrow. I want to concentrate on one at a time and explain the parameters on each one. Let's go to the USD. Here it's 100% on the daily range at 98. The 4-hour range is at 180%. Probably here it's okay to double your risk and reward. And again, you have to measure it relatively to your account and whether you can sustain. Don't look at it if you can take the reward. Everyone can live with reward. First, you have to think, can I sustain the loss, and you know, and whether my stop losses are okay for this kind of market. And obviously, there's a much higher volatility in the 4-hour range. Okay, let's transition a little bit to the E-mini S&P. Clearly, you see today, you know, this bar is not, I don't think it's finished yet. Let's see. Okay, if you put if in this on MT4, MT5, if you put it here between the candles, it would pretty much tell you. This bar probably is not closed yet, so we don't know. But today's activity, pretty much now, it's what's the time right now? It's 3:30. Okay, so this bar obviously didn't finish yet, but up until now, we had a daily range of 120%. The average of the daily range is 100%, but today's volatility was at 300% of the daily range. So we had a market open that went all the way lower, and then it came back all the way higher, and this is because of 3M. They released there was an announcement today that they're going to lay off 2,000 people, and also their earnings for 2019 are probably going to be lower. So obviously that caused a huge drop in the morning, and the market came back. So there was, you know, pretty high volatility. Now that we're towards the end of the day, there's nothing to do. you know, we see that it's just fluctuating towards the close in the next half an hour. Okay. What do we have here? Is natural gas? Jake, you put natural gas. Okay. All right. Well, look at this. So here is something interesting. We have 50% on the daily range, but 400% on the 4-hour range. Clearly, this is a day where your typical risk and reward in the marketplace has to be judged again. The market has been a lot more volatile. And obviously, you know, sometimes you can gauge visually. Look at this bar. Clearly, you know, this volatility, you know, in the last the first 4-hour average true range has been just tremendous. So this is what you're looking at. And obviously you see that after you also have to be observant of the chart and also see that after every big drop like this, or I mean a very volatile this like this, we're going into a choppy period. Here we didn't, here we did, here we did, right? So now that you're here, that we have gone already past the 4-hour range, we might get into a narrow range over here. Okay, let's go to the next market. The gold, for the gold bugs that always think gold is going to go up. The world will explode and gold will go to 10,000. All right, let's see. Daily range here is 125%, slightly above average. The average true range is slightly above average. The 4-hour range is 257%. So again, here we see, again, we're going to go into everything here. We're going to explain everything. And after that, it will give you a completely full picture. But I just want to go variable by variable to explain it. So again, we're going from, in this place, we're looking at average true ranges as we go from daily to 4-hour and 1-hour range. And we're looking for some sort of a consistency, or if there is a lack of consistency, we have to decide what we want to do. So again, you know, multi-time frame allows traders not only to look at support and resistance. There are people who look at support and resistance, you know, on the 1 hour, the 30 minutes, they go into bigger time frames, they even go into the monthlies and weeklies, but that's a visual gauge. It's very hard to build an indicator around it, but average true range, it's a mathematical formula. It's easy to put in place and see it, and it's math. You can't argue with math. So a 4-hour range here is 257%. If you're trading shorter time frames, you know, obviously you at this point it's double, and it may potentially increase from here or not. But that's already a guess, and we don't want to guess. So okay, and the next one, the crude. Again, very interesting. So we have the daily range at 133%, which is 33% higher than its average true range for the last 5 days. And here we have 340%, 338.65. Again, what you want to do post periods like this, right, is also look at the chart and see back what did the market do after volatile periods like that. Right? And many times you see that it goes into a sideways. And many times the market is in a sideways pattern. But what you want to do after you observed this, you want to say, okay, let's say you know right now that the market has been very, very volatile. If you've been in the market and you are seeing that the volatility grows while you're in a position, you can make a decision whether you want to stay in the trade a little bit longer. Usually volatile periods get sometimes a lot more volatile. Again, in trading, I don't want to get into generalization. We say typically and most likely, because anything can happen, right? So you always have to be open-minded, and you have to be very flexible as a person. So again, the first video was over the daily range, 4-hour range, and tomorrow we're going to go over the 1-hour range and see how that is actually affecting, this is how it affects your trading. And then we're going to put all of those things in context for you and how to trade it. And until next time, it's Med Z from the Optimus Studio. I'll see you guys tomorrow. Bye.